Everyone is talking about Palm Jebel Ali as Dubai's next big thing. But the question is, where do you invest before prices explode? Because the truth is, not every project on Palm Jebel Ali will perform equally, but there is one development quietly sitting in the spine of the island, Palm Central Private Residences. That might just be the smartest luxury entry point in Dubai's future waterfront economy. By the end of this video, you will understand why Palm Central could outperform almost every other early stage luxury project launched in 2024 and 2025. This video consists of 7 parts. Part 1, Palm Central's value proposition and architectural scarcity. Part 2, the strategic competitive universe defining the others. Part 3, comparison set, a benchmarking the ultra prime ceiling, for example, the Passo effect. Part 4, comparison set B, the emerging island rivalry, which is Dubai Island. Part 5, comparison set C, the mainland scarcity premium. Part 6, strategic investment thesis, maximizing capital efficiency. Palm Central Private Residences is anchored within the Palm Jebel Ali master plan, a development presented as a city-scale destination and a cornerstone of Dubai's future luxury landscape. Palm Jebel Ali is twice the size of Palm Jumeirah. This massive scale dictates that investment in Palm Jebel Ali, including Palm Central, must be viewed through a lens of a long-term luxury hold, not a short-term. The project's success is underwritten by the developer's early commitment to critical infrastructure. Palm Central is situated on the spine of Palm Jebel Ali between fronts M and N, benefits from a critical infrastructure advantage, a dedicated 5-kilometer access road connecting directly from Sheikh Zayed Road all the way to Palm Jebel Ali. By ensuring premium connectivity early in the development cycle, the developer, which is Nakheel, strategically establishes a high floor price for Palm Jebel Ali address. Palm Central distinguishes itself through a deliberate low-density resort-style architectural choice, a rare approach in Dubai's predominantly high-rise waterfront environment. The project comprises just 212 units housed across 3 elegant low-rise stepped buildings. If we talk about the configuration of the building, which is basement, ground floor, and then 6 floors in total and a roof. This step design maximizes uninterrupted views overlooking the cove from all key units. The extreme scarcity of these 5-bedroom penthouse and 4-bedroom townhouses, collectively less than 5% of total inventory, confirms that primary capital appreciation driver is the scarcity premium inherent in the typology, significantly amplifying the potential for the upper appreciation projection. The amenity load encompassing 18 plus features such as infinity pool, paddle courts, beach, volleyball, and an outdoor cinema, essential for sustaining the high rental and resale premiums. The financial structure of Palm Central is designed to maximize capital efficiency for the early phase investors. The launch price per square feet is strategically positioned between 3,000 to 4,000 dirham per square feet. Based on this entry point, the project forecasts a projected gross rental yield of 6 to 7%. This target is notably elevated, yes, exceeding the established average gross yield of 4 to 5.5% observed across stable prime Palm Jumeirah stock. The most impactful financial component is the highly leveraged payment plan structure, which is 20% down the payment, 50% across 4 years of construction period, and 30% upon the handover. Investors benefit from the capital appreciation expected on the full property value. Historically, 15 to 30% appreciation on Palm projects during construction, while locking up only a minimal percentage of the total capital upfront. This disparity between deployed capital and appreciated value substantially leverages the returns compared to deploying 100% capital into ready stocks today, making early stage entry into high prestige markets financially compelling. The user query directs the analysis beyond conventional immediate peer comparables such as Serenia, Tiara, and Oceana, which represents established assets from Palm Jumeirah's past development cycle. While established projects like Tiara and Oceana provides useful benchmarks for potential exit pricing, they fail to capture the dynamics of early stage large scale appreciation on a new island. Therefore, the strategic competition is defined by assets that test the boundaries of price, scale, and location prestige. Competitive universe of Palm Central is structured into three essential strategic sets, each challenging a different facet of Palm Central's value proposition. Set A, the ultra prime branded ceiling. This set is used to measure the absolute maximum achievable price per square feet for a new Palm inventory. By quantifying the price differential, the inherent unbranded discount applied to Palm Central is defined, allowing for modeling of potential long-term price convergence. This comparison is vital for assessing Nakhil's internal strategic pricing segmentation. It benchmarks the value proposition of the legacy exclusive Palm Jebel Ali address against the volume-driven, value-oriented taken on Dubai Island. The mainland is scarcity premium. We are talking about Jumeirah 1 or Jumeirah coastline. This analysis compares Palm Central unique low-rise resort typology against high liquidity. To accurately model the maximum appreciation potential for Palm Central, particularly for its scarce trophy assets. This ceiling is currently defined by Passo, by Beyond on Palm Jumeirah, where new inventory sets the ultra-prime benchmarks with price per square feet metrics frequently exceeding 7,000 dirham plus. The analysis of the price gap between Palm Central and the Passo benchmark reveals the extent of the early entry discount being offered on Palm Jebel Ali. Palm Central penthouses, for instance, launched with a price per square feet of 3,800 to 4,000 dirham. This positions them at a substantial discount, approximately 45 to 75% below the Passo ceiling. Similarly, Palm Central 4-bedroom apartment launched at 3,700 dirham per square feet, which is already below the lower bounds of established Palm Jumeirah prime project. Larger typologies, specifically the 4-bedroom and 5-bedroom and the townhouse units, are expected to benefit disproportionately from the scarcity premium, leading to stronger relative capital appreciation. Historically, Palm Jumeirah projects have demonstrated 25 to 40% appreciation between launch and handover. The critical timing for Palm Central's appreciation curve is projected to be around 2029. The successful high-quality delivery of Palm Jebel Ali master plan will be the catalyst that converts the current perceived risk premium into a realized prestige premium. The price gap with assets like Passo will rapidly compress. This market re-rating, particularly for assets like 10,000 square feet of penthouse, provides the financial justification for the aggressive 5,500 to 6,000 dirham price per square feet exit target. Investors entering today are deploying capital at pre-prestige price point, betting on the imminent market recognition of Palm Jebel Ali's superior scale and exclusivity. To understand the intrinsic value placed on the Palm Jebel Ali address, it is necessary to benchmark Palm Central against Nakhil's own launch on the other major reclaimed master plan. We are talking about Dubai Island. This provides a clear articulation of the strategic pricing disparity between the two major coastal growth zones. Nakhil has clearly segmented its master plans to attract distinct capital pools. Palm Jebel Ali, Palm Central. The investment thesis centers on legacy, exclusivity, and a long-term luxury hold, commanding a higher entry price point. It is defined by its massive scale and anticipated prestige. Dubai Island. The strategy focuses on on value, accessibility, and mixed-use offering, targeting a medium-term investment horizon with earlier return potential. Dubai Island's residential offering is heavily skewed towards apartments, roughly around 92% of the total supply on Dubai Island, positioning it as a value-based waterfront alternative. Analysis of recent launches on Dubai Islands provides concrete data for the competitive environment. For example, if we talk about Ellington Cove, this project serves as a high-quality pier on Dubai Island. Its one-bedroom apartment starts anywhere between 2.2 to 2.5 million for approximately 800 square feet, placing the launch price per square feet around 2,750 plus and beyond. Ellington Cove has an expected handover date of Q2 of 2028. Then we're talking about Nakhil's very own Bay Grove on Dubai Island. This project represents the value or entry tier of Dubai Island's master plan. Palm Central one-bedroom launch price per square feet anywhere between 3,000 to 3,400 dirham is intentionally priced 5 to 15% higher than Dubai Island. This difference confirms that the market is already applying an immediate valuation premium to the Palm Jebel Ali address, quicker yield, and slightly lower price point offered by Dubai Island projects. This strategic pricing segmentation validates that Palm Jebel Ali is perceived as an inherently superior, albeit longer-term, capital allocation choice, contrasting with the velocity seeker who may prefer the earlier returns and yields focus of Dubai Islands. Palm Central's distinct design, low-rise, stepped architecture coupled with direct beach access and comprehensive resort amenities. This specific typology has a proven track record, as demonstrated by the successful operation of resort-style low-rise development such as the 8 on the Palm Jumeirah Crescent, Solaya in Jumeirah 1 or the Lamir. Demand for this low-density, resort-focused design is robust and persistent. Solaya, situated on the constrained mainland coast of Jumeirah 1 or Lamir, is a direct strategic rival to Palm Central. Critically, Solaya's expected Q2 2029 handover date aligns with almost perfectly with Palm Central Q3 of 2029 completion, forcing a direct capital allocation decision between the two assets. Solaya commands very high starting ticket prices, for example, 14 million plus for a two-bedroom apartment, reflecting the extreme scarcity of developable beachfront land on Jumeirah mainland, which translates to a substantial price per square feet premium. Investors must choose between geographic security and liquidity, Solaya mainland location, and unparalleled scale and exclusive resort living, Palm Central. Due to the vast scale of Palm Jebel Ali, Palm Central can offer an expansive array of 18 plus amenities that cannot be replicated on the space-constrained mainland plots of Jumeirah 1 or Lamir. The extensive and high-quality amenity suite at Palm Central, including a private studio, club lounge, state-of-the-art gym, and various beachfront facilities, is not merely a marketing feature. Palm Central presents a highly favorable structural anomaly in the market. It projects a rental yield anywhere between 6 to 8%, typically associated with high-demand affordable housing, which is average 8.3% in yield, while simultaneously offering a position within the high capital appreciation luxury segment, which has shown 8% appreciation in 2024. This exceptional combination of high projected yield and high appreciation potential is a direct consequence of the initial launch price discount. The synthesized analysis confirms that Palm Central is designed to achieve a rare dual mandate in the prime real estate sector. The projected gross yield of 6 to 7% represents a significant uplift, approximately 27 to 55% higher than the stable average yields achieved on Palm Jumeirah, which is only 4 to 5.5%. This high yield projection validates the efficiency of the asset's initial pricing relative to expected rental income. The 20-50-30, like 20% down payment, 50% during the construction, and 30% upon handover payment plan is the central financial tool for maximizing investment return. By deferring 80% of capital until after the initial booking, the investor is positioned to capture the historical 15 to 30% appreciation typically seen during construction phases while only committing a fraction of total property value. This leverage effect substantially amplifies the return on invested equity or IRR. Investors are advised to utilize this deferred capital structure to maintain substantial liquidity, allowing for parallel capital deployment or maximizing cash flow efficiency over the entire 4-year construction cycle. The allocation strategy should prioritize securing the scarce large format assets, townhouses and penthouses. These trophy assets directly compete with the highest priced inventory, for example Passo by Beyond, and possess the highest potential to realize 40% bull scenario appreciation. These scarce units are positioned for superior long-term performance due to their unique features: double height ceiling, private pools and private gardens, and limited supply. They command higher projected exit price per square feet, anywhere between 4,300 to 6,000 dirham upon handover in 2029, making them the financially superior choice for investors prioritizing aggressive capital appreciation over immediate high volume liquidity. Palm Central Private Residences is not merely an addition to the Dubai waterfront. It is the strategically discounted, highly leveraged luxury entry point to the Palm Jebel Ali master plan. The project is engineered to achieve rapid price convergence with existing Palm Jumeirah prime assets like Oceana, Fiora pricing, and is fundamentally positioned to eventually challenge the price ceiling set by the branded ultra prime category. This structural value proposition provides a clear path for substantial ROI for the patient strategic investor. If you are ready to position your portfolio at the strategic entry of Palm Jebel Ali, the time to register and act is now, because each upcoming launch would come at appreciation, and you being the early bird would enjoy maximum capital appreciation.